Well, with us now, once again from Primary Financial, it's Richard and Carl, my two favorite guys, talking about LTC, which is actually long-term care. Hello, how are you?
Good, Donna, how are you?
Good. So I was laughing because every industry has their own acronyms.
Right.
Long-term care is what we're here to talk about today.
That's right.
How do most of your clients deal with long-term care?
So, Donna, as always, great to be with you.
You too.
All right. Long-term care is a very unique concept to discuss. In the financial planning world, Carl and I and our colleagues feel that long-term care is an under-discussed topic in the comprehensive financial planning world, for the simple reason that if it was to happen to an individual, it can have a catastrophic effect on their overall finances. Right? So, as most things in life, things change, and the topics and the choices that clients have when it comes to addressing their potential long-term care issues has changed drastically over the years. So some clients, most clients, I would say, come to us with the idea that one of their major goals and objectives is they don't want to be a burden on their family, but they don't really understand how or what their choices are in terms of planning for long-term care. What Carl and I would like to do is discuss a couple of the ways, and certainly point out the ways that things have changed, and certainly point out some of the options that may not have been there 10 years ago. But what we would like to stress is the importance of a long-term care topic in any comprehensive financial plan.
Yeah, so what I would point out is that when you have long-term care, you're really talking about end of your retirement age planning. You're talking about something that's going to be 75, 80 years old, most likely. And what happens is that your assets have to get spent in order to take care of your long-term care needs, whether that's having someone come in your home and take care of you, or having to go to a long-term care facility such as a nursing home. So what happens is that there's really kind of three options that people can come up with.
Okay.
Number one is that people decide that they're going to fund their own account themselves. They're going to build a cash account and they're going to deal something to have to spend it. That's not really the greatest outcome, because you never know when that event's going to occur, because it might be in the second or third year of planning and now you don't have enough money to take care of it. If you have 20 years to plan for it, different idea. So what you try to do is get some type of insurance plan, which is a long-term care insurance policy. Mm-hmm. So pretty typically, you're going to get a 5-year policy, say $100,000 a year to take care of it. And what happens in traditional long-term care is that there's no fixed premium. So as time goes on and you get older, the price of it goes up. And then there's three real outcomes that occur from long-term care insurance. Number one, you live a nice, long, healthy life and you never ever use the money. So all that premium dollar was thrown away. Number two is you go on care for maybe 2 years, or say 2.5 years. So you use $250,000 of that care event that you bought, but now the other $250 goes unused. Again, premium wasted. You bought a $500, you only used $250, the money's gone, the insurance company wins. And the last one is to get sick for 5 full years and then at the end really extract all the money. So the three options available in traditional long-term care are bad for your pocketbook or bad for your health.
Right. That's three choices, I don't like any of them.
Well, and nobody does. So
nobody does.
So the life insurance company stepped in and said, listen, here's what we can really do. Instead of having people buy just a single life insurance policy, let's combine a life insurance policy with long-term care. Okay. So we kind of solved those three negatives. And what happens is that the first option, let's just take the same thing. I live a nice, long, healthy life, nothing goes wrong. What happens? I pass away, the money goes to the $500,000 goes to my family. Second option, I use half of it. So let's say I use half of the insurance policy. Well, the remainder of valiance would then go get paid as a death benefit. So I get all value out of it. The last one is, I'm sick and I'm in place and I use it all. So any way you look at it, the life insurance, so it's called a hybrid life insurance policy.
And that's what you have to ask for,
and
right?
You have to ask for that. You have to get a quote for it. And it's a combination, life and long-term care or a chronic illness rider. Those are the two jargon words that you want to look for when you're looking at regular life insurance policies these days.
And I think what's happened over the years is that there's been such a negative connotation with the traditional long-term care product itself. To Carl's point, we feel that the financial service industry, while it's gone through its own host of changes over the years, we feel that it's been pretty resilient in terms of the design, the actuarial design of these products. Now clients have a choice of things where they can measure the amount of input versus the amount of output. And if I could just say that in my almost 20 years of experience, what we're looking at in terms of the long-term care topic is that people, especially advisors, but most of the time consumers are so wrapped up in the concept of accumulating their money. You gotta grow. And when it comes time to talk about how that money is to be spent, this topic tends to get overlooked. When you couple that with the negative press that's associated with it, the industry, how to react to it. And we feel it's done a pretty good job of that.
Are any of the old policies convertible?
So depending on the type of insurance policy
Okay.
you have,
Okay.
if it was an old life insurance policy, you can convert the old life insurance policy into the new one with the hybrid feature of the long-term care chronic illness rider. Of course, you have to qualify medically. You have to prove that you're insurable. The old long-term care policies, unfortunately, they don't. You have to keep that policy going the way it is. But to talk about the distribution, so again, let's say you had a long-term care event that you were going to experience. And let's say you have a long-term care insurance policy and you have your IRA. And you wanted to spend down your IRA first because you said, I don't want to buy that long-term care insurance policy. So let's say you needed $100,000. Well, every distribution from your IRA is going to be taxable. So you might have to take $125,000 or $130,000 out of your IRA in order to get that $100,000 just to give it away. Where on the insurance policy side, you get what's called leverage when you purchase an insurance. I don't buy a $1 insurance policy for $1. I only pay maybe 10 cents or 20 cents for it. So if you have a $100,000 insurance policy, you might have only paid $10,000 for it. So now when you look at it, okay, I can take this dollar, which is leveraged up. Is this dollar cost me 20 cents, but this dollar costs me $1.25. Which one would you rather spend and give away? And that's why we say it makes perfect sense for someone when they're doing financial planning to incorporate this, because that's really a game changer. If something was to happen, you're wiping out a lot of your savings.
You know what makes perfect sense to me is calling you guys. Right?
We're here to help.
Because
Always
the
happy
plan
to
doesn't
help.
have to make perfect sense to me. But if I sit down with you and you know the details and you can explain it to me in such a way, then you can obviously make the better choice. $1.25, you could figure it out.
Correct.
But you
Absolutely.
should have something. And at what age can you get a policy like that?
Well, I mean, long-term care planning, it can start at any age, especially
Okay.
with the combination of products that are available now. To Carl's point and my point earlier with the hybrid sort of contracts, well, we're finding that most people want to address this at the time of retirement because that's the connotation of when it should be addressed. We're finding the opportunity to put a client in position to take advantage of these products at a future stance in life happening much earlier. So the short answer is it's never too early to plan for anything, all right? But the long answer is the traditional ways of us helping clients out in this topic has definitely started at a younger age.
Yeah,
I think I have an
I would say in the
idea.
40s.
In the 40s.
I was going to say, I'm no financial planner, but I have an idea. I was going to say, what happens if you have your first baby and you start thinking about their college and at the same time you start thinking about your long-term care?
Yeah.
Do you like that? That's a good rule of thumb.
Well,
right?
It's not a bad idea, but we
Okay.
always tell people you can finance a college education. You can't walk in the bank when you're 65 and say, I'm about to retire, I need $1 million loan, please.
That's right.
So we tell people
good advice.
if you're going to make a choice between college planning and retirement planning is definitely the one you should fund
That's right.
first because there's a much different options available and it's a shorter term obligation for college funding.
That's great.
People aren't naturally motivated to go out and do these things.
No,
Our
of course
recommendation, whether it's us or somebody like us, our recommendation is always to have a relationship with an advisor so they can keep an eye on these things over time. Change in products, change in circumstances, all that stuff's going to happen. Having an advisor that knows your situation will help you along the way.
And one of the reasons that I love working with you and I love having you guys on is for that reason. My job is to bring the best resources and talent and ideas and entertainment to my audience. Every month I've got to feed them like the best of the best, right? So I thank you for being here because it's an overall combination. The show is like, fitness, finance, food, music. And in fact, I don't know, but did you know who's in the house today? Christian
Who's that?
Gurdy, You're going to go hang out with us and
Absolutely.
dance?
I hope
He
so,
wrote
yeah.
a brand new song. It's a love song.
Okay.
Have you ever been in love?
I am.
Are you in love?
I'm still in love.
I'm still in love. I'm still in love.
Blushing. There you go. Stay tuned for more. Christian's going to be coming up very soon.